Hello, welcome to my video. Do you think the stock market is safe to invest now? It's just going up only? Well, I'm here to prove otherwise to you and why you should be careful. So this video is called The Imminent Top of Equities and Why No One is Talking About It. Take in mind that this video is not financial advice and this is merely my opinion. Any actions by the viewers solely is their own responsibility, okay? Have you been feeling like any news, the market just gobbles it up and goes back up again? And some of your friends, everything then happens in the news, it's up only, it's going up, it's going up. I feel like emotionally we're at the later stages of this market. I don't know if we're here in greed, illusion, or a new paradigm, or just enthusiasm, but we're really close to the end. Okay, and so we're gonna go over three things: why the market is a used psychological manipulation machine, and why it works, and why does it matter, and where we are in the current cycle, and what usually transpires in this current part of the cycle. So let's start, and also why humans repeat themselves over and over, and why winners win and losers lose. Okay, so let's go over the psychological part. It's the most important initially. Okay, you obviously cannot feed your family without money, and you obviously cannot pay your bills without money, right? So in a world with increasing costs and inflation, a simple job is nearly not enough to pay for all the bills, food, and live comfortably in the majority of the world. Okay, so where do people get more income? They either work harder, right? Get more qualifications, side hustles, part-time, etc. But all of this, the easiest ones are betting and gambling, or investing, or working harder, or part-time jobs. It's easier to start, requires almost no upfront time or investment cost. Right? Actually, investment you do require costs, but not time required to study. And why is it ever way harder to get basic needs with a normal job? If you go over to the data here, worker pay with productivity, so net productivity has gone up, worker pay is not nearly enough. GDP versus wages, okay? So this is the GDP per capita, and this is the wages, average wages per person. Overall working hours to invest in a market. So after 1971, the average was 30.9, and now it's around 120 hours just to buy an S&P stock. Overall inflation as well, as you can see, is going up. The house price in New York compared to the income, obviously a huge disparity in correlation. We can go over all this data, but you already understand the basis of this. I don't want to make it a long video, but home value versus income change as well. How long does it take to have a house? More than 6-7 years currently. This is in 2020, it's probably higher even now. And so you can see all this data in this website if you want to check it out. I can put it in the description if you want. And saving as a percentage of income as well, it's going even lower with time. Okay, so now we understand that people need to save themselves from their financial situation, right? Now we might understand a bit of their psychological decisions. So let's go over some simple mathematical stuff. So 100 multiplied by 2 is 200, right? Correct? And 10k multiplied by 2 is 20k, right? Okay, so 20 euros paid for some groceries, maybe gas, maybe helps the rent a bit, but it's not a lot, right? Now 20k, however, covers all your yearly expenses and probably more depending on the country and city you live in, right? So the difference here is that both investors meet the same returns, which is 2x, which is 100%. And both investors use the same system. However, the emotional significance that we attribute to 200 and the emotional significance that we attribute to 20k, it's quite different. And so this person might think that he is not making anything work, not making anything good. And this person might feel like that he's on top of the world and that everything's amazing for him. But they're both doing the exact thing. Except this person will not reinvest because he's satisfied, and this person will reinvest or hold longer because he's not satisfied. So eventually, what happens here is that this person, it gets the money out of the market. And this person, it tries to go for 10x instead of just a 2x and ends with 0. As I said, the emotional significance in the first case is almost nothing. So the first investor believes it's not enough and tends to hold longer. It gets to 275 and ends up with 0. And the second investor gets out of 20k, the initial profit, taken out. So this one wins and this one loses. They did the same thing, but for this one he had larger initial capital, so for him was enough. For this one he wanted to change his whole entire life with just 100, which is not enough. Okay? And so why does this happen? And why does it influence the market? So as you see, the market is literally an emotional manipulation cycle. So in the beginning, people are afraid that the rally will go up. Why? Because the normal person, the average investor, let's call him for simplicity's sake, the average investor, he requires certainty because he cannot lose a lot of money because he needs to pay for bills and his job and everything, right? Okay. And so what happens here is that they do not want uncertainty, so they enter, not usually some enter in hope, but the majority enter in optimism, belief, and thrill. So they enter when there's least gains to be made. And so they enter when it's certain, and they enter with less size. Because they need what? Certainty. Because they cannot lose money, but they want to change their lives. And so they enter exactly where they shouldn't be entering, and with less size than they should have been entering with. Okay? And then, when it gets to the top, the market will surely give them the news and the conviction to hold even longer. And when the market starts going lower, they still have the conviction and everything because they require certainty, and the market is sure to give them on the highs and the lows. There is the most positive news on the market ever on the highs, and there's the most negative news ever on the market at the lows. Okay? So the average enters on belief, thrill, euphoria, yeah. They're fueled by the need to escape their life, exactly as I talked about. Okay. And so the market is sure to give them what they need, which is certainty. Even though it is false and emotional manipulation. So as you can see here, this is the 2008 crisis. And if we look at the lows, you can see more bad news, employers cut 401k matches, recession looms in Louvre. You also have your credit default swaps, Earth's net income, Nasdaq plummets more than 2.5%. Europe tips into recession. Freddie needs 30.8 million as mortgage defaults worsen. So at the absolute lows, you had even worse news. And if you go back, you also see like a lot of companies still letting people go at the absolute lows. And if you go to the highs, you only have like absolute positive news. And probably you can have even more better news. Like that's all I could find, but you probably have better if you dig deep enough. So the market is sure to give you the certainty and the fear at the extremes, the absolute most, because knowing this average investor, and we need their money, because if they don't invest, and they aren't emotionally manipulated, the big capitals, the big investors, they don't have like enough liquidity to play with, right? So we need those investors, and so the market is sure to give them absolutely exactly what those investors need, which is the absolute fear of entering when it's higher opportunity, and the absolute greed of not exiting when it's the lowest opportunity. And the certainty and the uncertainty exactly when it is required. The certainty when it's the worst time to invest, and the uncertainty when it's the best time to invest. And this is why the market is exactly a giant ball of emotional, mental, psychological manipulation. And why we can predict exactly where the most people will exit and what most people will enter based on the financial situation of the majority of people. Okay? And so now that you understand this, let's go where we are in the current cycle and what typically transpires. Okay? So, purple line is unemployment, orange line is the inflation year on year, and green line is the Fed's rate. Okay? So if we look here, this is the Nasdaq. Okay? So if we look, we had inflation going up. Okay? The Fed rates went up as well. And then after the Fed rate stopped, we had unemployment go up a bit. And as you can see, Nasdaq was correlated with that at the same time. If we look here as well, we had inflation going up. We had inflation going up here. We had an initial of the cycle of the Fed's rate. Then the market started going down, and employment went up as the market went down. Okay? And then inflation went lower when the employment got up. Okay? Because unemployment is usually the thing that kills inflation. It's usually just the Fed cycle just usually leads to unemployment. There's too many variables for the rates to delete inflation, because below 2% is really hard to get to, and so usually it's unemployment that gets the job done. And you look here at this time, we have had, this is the COVID cycle. We've had inflation going up, the Fed cycle go up again, then unemployment spiked because of COVID, and then the Fed rates went down, and then unemployment went down, and the market rallied. And here we are in the second part of the stage where we had inflation go up, right? Inflation go up, Fed rate go up, okay? Fed rates easing as last time. So now all we have left is unemployment going up, okay? So then inflation goes down again and the market cools off a bit, okay? So all we have left is the cooling off of this cycle. That's what we're currently expecting. And so we're in the later parts of this chart. So greed, delusion, new paradigm, and every time everyone says like this time is different, you just must question them, because it was never different. Why should it be different now, right? Someday eventually it will be different, but until proven otherwise, there's no reason to bet on it, is it? Yield curve is one of the greatest recession signals of all time. It has never failed, and it is every time it inverted back up, it leads to a recession. And as we can see here, it inverts back up, recession, inverts back up, recession. I'm looking this way because my monitor is right here, but yeah. Inverts back up, recession, it inverts back up, recession, it inverts back up, recession, inverts back up, recession, and this time we still haven't had a recession. So it is fair to say the likelihood of an economic slowdown is very big, okay? As you can see, this is very common nowadays, isn't it? Wealth gaps increased during bubbles, and they became particularly galling for the less privileged during hard times. It is during such times that populism on both the left and the right tends to emerge. How well the people and the political system handle this is key to how well the economy and the society weather the period. As shown below, both the inequality and the populism are on the rise in the US today, much as they were in the 1930s. In both cases, the net worth of the top 1% of individuals equal approximately that of the bottom 90% combined. And so this is happening all around the world. Populism is emerging again, and also not because of just wealth gaps, but because of other issues, but it is very equivalent to what's been happening. Just for you understanding some things as a long-term cycle, the economy moves like this. So you have a long-term cycle, which is the US as long-term as a world power. So the long-term debt cycle is them being the reserve currency. And then you have the economic cycles and short-term debt cycles, okay? Which is basically what we're trying to talk about, just the short-term. We're not talking about the long-term, even though it is likelihood that we're close to the end of this long-term debt cycle. This is not what we're talking about in this video, okay? But it's clear that we're in the euphoria part of the cycle or close to it. And so all we can do is just take percentual profits every week or every day or month or whatever, however you feel better. But if you're in profits, you take the money home, okay? I think that's the best thing to do, at least in my opinion. You don't need to follow me. You can just FOMO into oblivion and everything's going up, and it might work for you, but it might not work. I believe that if you're up good amounts, you should take profits. I've suffered from this before. I've been up this year a lot of money, and I didn't take profits in half of it, so I've learned my lesson. And yeah, this is my idea. This is always my idea, and that's why I've always wanted to take profits here. But in crypto, it would have worked different. I had to have different systems. I had to take profits earlier. Okay, so, and why the majority of people lose money in the investing. The desire for constant action, irrespective of underlying conditions, is responsible for so many losses in Wall Street, even among professionals, who feel that they must take home some money every day as though they were working for regular wages. They say there are two parts of a bull market, the first 8 and the last 8, and they have cost more money than the whole of the rest of the market. If a man had lost as much money trying to catch these 2 8s as the street has, he could build a highway across the continent. And so in conclusion is that the first 8 of the market and the last 8 are the worst times to enter a market and to where more people lose money. So as we can see here, The first state and the last state is the worst part. And why is that? It is because these are the parts where we have the most uncertainty and the most uncertainty and the most certainty. Wait 1 second, I have a trade here that I might have to cut. I was trading at the same time. Okay. Okay, let's see how it goes. Okay, and so I'm back. Continuing. And so it is very important for us to not get overly extended, enter too much in this beginning stage, or exit too early, too late in this late stage. Okay. So let's go back up here, where we're talking about, and the market is sure to give you the most positive news at the edges, right? So we had at the lows of the market last year, besides the recession and COVID and everything, what fueled the 2021 bull run was a stimulus checks from Trump. And so now we're having that talk at the all-time highs. And so that scares me because we're having the absolute best news and the thing that drove the 2021 bull run at the absolute highs. And that's not something that I like to see, okay? It really is not. And so 2021 bull run was fueled by central bank issued QE. This means that creating the balance sheets of private banks, instead of creating empty balance sheet in private banks, it creates on the central bank and then lends that money to the people instead of creating that 0% interest and empty balance sheet in a private bank and then facilitating loans. It creates in the central bank itself and then gives that money to the people so they can invest in the economy. And that leads to the market going higher because if people are buying products and investing and stuff, the market go higher. And then more people tend to enter because if market goes higher, they have fear of missing out and not making money, and so they enter, right? And so why is it like such a good news at the top, right? It shouldn't be good, right? So that's the constantly euphoric bull markets. What happens when we are at extremes is that we tend to justify everything with news. So my friend, for example, is his first year investing. It's all going up for him in stocks. It's better than in crypto, honestly. And he saw Trump news, he gathered with all the CEOs and some IANAs, and he called me saying, bro, what if the tariffs are for the American people, where it replaces the industries with robots faster than every other country and lowers prices while increasing the paychecks due to lower costs and more income? It's going to go up long term. It's crazy. And while, imagine, it does make logical sense that if he, as the tariffs, reduces the manufacturing costs in America, and then the tariffs use that money to pay for the people while he has lower manufacturing costs, he can indeed reduce the costs of everything in America while having the greatest exportation industry in the world and more efficient and lower cost. But the thing is that, well, might be a deductible statement and might work out. You don't know if this is going to work out in the short term, and we also have to consider that we're in the end of this long-term debt cycle, and that the likelihood of this working is also very low. So even if this works, it wouldn't be for now, and it would not invalidate a recession or an economic slowdown in the next few months. Okay? And so it is very likely that when people are in euphoric bull markets at the top of the top, they justify anything at all, any news, and that their position and their right to hold the price is right. And so they everything fuels their certainty, and which leads to even more issues because even here they think the market's continuing to go up. It's no way it's going to go down. Never in the history is going down in their minds, and that's the problem. It is a mental game. It has always been. And so now that we know the human psychology and where we are in the current cycle and what I think about it's going to happen, we can go on why winners win and humans repeat themselves over and over. So we are emotional creatures who remember mostly of our recent lessons, wins, information, and mistakes, and we forget the latter. If you go over to these poorly designed charts, someone who bought here at the lows and sold at the highs will likely also sell early next time because they have a reinforcement that buying low and selling high and holding is a good thing to do. But someone who didn't sell here will remember all of this pain, and next time the chart will go up, it will most likely sell too early because the pain is all it remembers, right? So this person will repeat their mistakes. But someone who bought here and sold here, but instead of like being grateful that he got all his move, he's regretted about not being in this move, and then rebuys here, he will still remember all of this pain. And so the way we react to everything is more important than the price action itself or the short itself. It's really just a mental game. And so we will forget the right things if we do mistakes in the middle, or if we react poorly to the situations after that we do the right things. And so people only remember the latest blessing or pain. This market is a psychological manipulation machine. And winners win because they continue to do the same things that work. They forget the mistakes, they forget the pain, they just forget the reinforcements. And in the case of markets, they do not need to hold as much time to make as much money in terms of the higher capital investor that we talked about here, this one. And they do not need to hold as long, and they enter with more capital more early. While the average investor, he enters with less capital later, and then adds the winner investor, he enters with more capital earlier, and he sells earlier. So it's a difference in both the ways they get in, the size they use, and the certainty that I need, basically. And so the way to fix these issues is to view investing as a bonus, not as a life-changing opportunity. It is not. If you're not capable of making a business, if you're not capable of teaching people or making software or creating ideas or creating content, like if you're not valuable itself as a person, investing is just gonna amplify what you already are, which is just, if you're patient, you'll make some money, maybe a lot of money if you hold long term, depending on the stocks you invest, if you're good at picking up the stocks or cryptos or whatever. But it's not gonna change your life. It is not a way out of your work. It is not. And it's none of the influencers and marketing and traders, even me, I work a lot. Trading does not require that much work, but I do work because I like it. I like reviewing my trades. I like to view my life as a game. I like to sleep early, view myself as an athlete. And so I do not view investing as a life-changing opportunity or trading. I just do it because I love it. I make this video because I love it. Oh, my trade hit. Yeah, that was just my trade that was in. Okay, so I was saying, and so I do not see this as a life-changing opportunity or as an extra bonus. Like, I see this as a game that I'm currently playing, that I love playing. I love the game. I love the thing. I love doing this every day. So to win here, you gotta take consistent gains instead of moonshots and let time compound. Okay, you gotta let time compound, and when you take consistent gains every day, eventually, like a $200 win, like I had here, as you can see, it will go like this is a 200 win in each account, which is a 400 win. Imagine if I had 20 accounts. Look at how much money I would have made. But instead of chasing like 2,000 on each account on a day, I just do this. Small gains, goes to target easier. I don't need to do a lot of money every day, just a small bit. But then if I had like 20 accounts, look at the money I would have made. Impressive, right? Life-changing. But it's the same thing that I'm doing with just one account. I just do it 20. It's not different. And so this is the mentality of a winner, and why losers lose. That's all they wanted to say, basically. And I think now you understand why the top is most likely soon. And even if it isn't, it is best to remove or reduce a bit of exposure. Take some profits and enjoy your gains. Do not think a market will change your life just because you're in it. Your life changes because you yourself change, and you're a valuable person, and you're intelligent, and you're creating stuff, and you're giving information. It's not just because you invested in Pepe, and Pepe went to bazillion dollars, and then now you're fucking rich. You after you get so much money, if you're not like used to losing and used to winning and all of these ups and downs, you're just gonna lose the money anyways because you simply don't have it in you. You don't have it in you, and that's the truth of it. And so 80% of lotto winners eventually lose everything, and that's exactly why this happens. Like when you win a lot, you're not used to it. It's like an energetic like bomb on you, and so you need to be used to that. You need to be valuable. You need to learn how to deal with pressure, with companies, make companies, make content, be valuable to the world. Basically, I'm repeating myself here. And yeah, that's it. That's basically all of the information I have here today for you. I did went off the rails a bit, but for everyone watching the video, I'm gonna make a Twitter post and a real format as well for the short-term goldfish attention span people, and a Twitter long post in form of text for the people who love to read. So I'm gonna do all the 3 formats, and yeah, that's it. And I'll see you on the next videos. I have a lot of new ideas, and I'm gonna make them. So see you soon.